A woman's car breaks down 3 days before payday. She needs $300 to fix it or she loses her job. Her bank won't give her a loan that fast. Her credit card's maxed out, so she walks into a payday lender and walks out 15 minutes later with cash in hand. The sign in the window says the fee is $45. That sounds manageable. It is not manageable. It is one of the most expensive borrowing decisions available anywhere in the legal economy. And the entire industry is built on the fact that almost nobody in that moment stops to do the maths. Here's the maths nobody does. A $300 loan with a $45 fee due back in 2 weeks sounds like paying roughly 15%. 15% doesn't sound great, but it doesn't sound catastrophic either. Except that 15% isn't the annual rate. It's the 2-week rate. Stretch that same fee structure across a full year, the way every other loan in existence gets measured, and it works out to somewhere around 400% annual interest. Some states allow rates well beyond that. For comparison, even the worst credit card in America rarely breaks 30%. Payday loans routinely land at 10 to 20 times that, and they're marketed using a flat dollar fee, specifically because a flat dollar fee doesn't sound like an interest rate at all. This isn't an accident of how the product happens to be priced. It's the entire design. Framing the cost as $45 instead of 400% is a documented, deliberate choice because human beings process a small, flat number completely differently to a large percentage, even when they represent exactly the same cost. Behavioral economists call this framing effect, and it's the same reason a gym membership gets advertised as just $2 a day instead of its actual annual total. The number is true. It is also chosen specifically because it hides the real scale of what you're agreeing to. Now here's where it gets worse because the fee itself was never really the business model. The business model is what happens 2 weeks later, when payday arrives and the loan comes due, and the borrower doesn't actually have an extra $345 sitting around, because if they had spare cash lying around, they wouldn't have needed the loan in the first place. So the lender offers a solution: roll the loan over, pay another $45 fee, and push the due date back another 2 weeks. It feels like relief. It is actually the single most profitable moment in the entire transaction, because that borrower is now paying a second fee for the exact same $300 with nothing paid down at all. This is not a rare edge case. Data gathered by financial regulators in the United States has consistently found that the majority of all payday lending revenue doesn't come from one-time borrowers paying off a loan in 2 weeks. It comes from repeat borrowers, rolling the same loan over again and again, sometimes for months at a time, paying fee after fee on a principal that never actually shrinks. The entire industry's profitability depends less on people repaying quickly and more on people getting stuck. And the locations aren't random either. Payday lenders are disproportionately concentrated in lower-income neighborhoods, specifically in areas where residents are less likely to have access to a traditional bank overdraft, a credit card with room on it, or family who can lend cash in an emergency. This isn't a coincidence of where rent happens to be cheap for a storefront. It's locating the product exactly where the alternative options are weakest, because a strong alternative is the one thing that would actually stop someone from paying 400% interest. Then there's the psychology of the moment itself, which matters just as much as where the storefront sits. Nobody walks into a payday lender when they're calm and comparing options carefully. They walk in during a crisis. A car that won't start, a utility bill about to get shut off, rent due tomorrow. Behavioral researchers call this scarcity mindset, and it does something measurable to how people make decisions. Under acute financial pressure, the brain narrows its focus almost entirely onto solving the immediate problem, at the cost of properly weighing the longer-term consequences. It's not that borrowers are bad at maths. It's that the entire situation is engineered to be approached at the exact moment human beings are worst equipped to evaluate a 400% interest rate calmly. Some countries and states have tried capping the fees or requiring lenders to check whether someone can actually repay before issuing the loan. In several of those places, the industry successfully lobbied to weaken or delay those rules, arguing that without high fees, lenders couldn't afford to serve high-risk borrowers at all, which is, in its own way, an admission of exactly what the business depends on. Borrowers risky enough that only an enormous fee makes lending to them worthwhile. None of this requires anyone to break the law. Every fee is disclosed. Every contract is signed. The interest rate, if you actually calculate it, is sitting right there in public regulatory filings for anyone who wants to look. The entire system works not because information is hidden, but because it's presented in a form that's technically accurate and psychologically almost impossible to interpret correctly in the 15 minutes it takes to solve an emergency. So the woman with the broken-down car gets to keep her job. She also, more often than statistics would suggest is coincidence, ends up back in that same storefront 2 weeks later, paying another $45 for the exact same $300 she started with. Not because she made a bad decision, because the entire product was built, from the fee structure to the storefront location to the timing of the offer, around the moment she'd be least able to see it clearly.